Would you like to own a slice of an extremely durable business that dates back to the 1700s? Want to invest in the future of America itself? Like the idea of getting a market-beating yield and double-digit dividend growth? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a megabank, helping to keep the US financial system properly running and expanding. Big US banks are practically money machines. They make money from money itself. Not only that, but they've become critical to the US financial infrastructure. As America goes, so goes the US megabanks. And since America has been a great bet for centuries, it's a great spot to be in. And that should lead to more revenue, higher profits, and bigger dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of JP Chase & Co., which appear to be trading at a significant discount today. JP Chase & Co., stock ticker JPM, is a financial holding company that operates as one of the largest financial institutions in the United States with over $3.7 trillion in assets. They offer various financial products and services across traditional retail and commercial banking, asset management, and investment banking. Founded in 1799, the bank is now a $414 billion by market cap global financial leviathan that employs 270,000 people. The company operates across four major business lines: corporate and investment bank, 43% of fiscal year 2021 net revenue; consumer and community banking, 41%; asset and wealth management, 14%; commercial banking, 8%. They also have a corporate business segment that results in insignificant negative revenue. With roots dating back to 1799 and the bank's fabled history intertwining with legendary business magnates such as JP Morgan, John D. Rockefeller, Thomas Edison, and Andrew Carnegie, JP Chase has blossomed alongside the United States of America. To that point, JP Chase is a symbol of American financial might. The bank and America itself have become almost inseparable. This is such a massive and critically important financial institution, it's almost impossible to imagine what would happen if it were to suddenly disappear. From retail branches to credit cards to capital markets, JP Chase touches pretty much every facet of US finance. Simply put, it's a vital part of America's financial infrastructure. Morningstar describes the bank like this, and I quote, JP Chase is arguably the most dominant bank in the United States, with leading investment bank, commercial bank, credit card, retail bank, and asset and wealth management franchises. JP Morgan is truly a force to be reckoned with, unquote. Another force to be reckoned with? America. And so I look at the two as a pair. As long as the United States continues to prosper, so should JP Chase. With a symbiotic relationship in place, you can't really separate the two. The US has been a winning bet for the last 250 years, and I can't think of a better country to bet on for the next 250 years. This puts JP Chase in an excellent position to thrive for many years to come. In turn, that should consistently translate into higher revenue, more profit, and bigger dividends for shareholders. As it sits, JP Morgan Chase has increased its dividend for 11 consecutive years. I think they're just getting started. The bank has been making up for lost time with a 10-year dividend growth rate of 16.5%. And you get to pair this double-digit dividend growth with the stock's market-beating yield of 2.9%. This yield, by the way, is 50 basis points higher than its own 5-year average. A low payout ratio of only 26.0% protects the dividend. I like dividend growth stocks in what I call the sweet spot. That's a yield of between 2.5% and 3.5% paired with high single-digit or better dividend growth. The yield is on the low end of that spectrum, but the big dividend growth more than compensates for it. Really good dividend metrics here. Looking at business growth, JP Morgan Chase increased its revenue from $97.0 billion in fiscal year 2012 to $121.7 billion in fiscal year 2021. That's a compound annual growth rate of 2.6%. Not excellent, but I think it's important to keep in mind that JP Morgan Chase is working with a huge sales base. That makes it difficult to rack up impressive relative growth, even if the absolute growth, a $25 billion advancement here, is really good. Also, the last 2 pandemic-impacted years have been difficult for banks in general. Meanwhile, the company grew its earnings per share from $5.20 to $15.36 over this period, which is a compound annual growth rate of 12.8%. That's more like it, a strong result. We can now see how they've been able to afford such generous dividend raises. Earnings per share growth has funded that activity. Improving profitability and extensive buybacks combined to propel excess bottom line growth. Regarding the latter, the outstanding share count is down by approximately 21% over the last 10 years. Looking forward, CFRA believes that JP Morgan Chase will grow its earnings per share at a compound annual growth rate of 2% over the next 3 years. This looks disappointing, if not shocking, when we see what the bank has put up over the last decade. To be fair, I think it's difficult to find accuracy and clarity in this environment. We have war in Ukraine, raging global inflation, an energy crisis starting to play out in Europe, and the specter of the US Federal Reserve potentially causing a recession by raising rates too aggressively. On the other hand, inflation could be tamed by a combination of higher rates and a normalization of supply chains. Any good news out of Ukraine would be a huge relief to everyone, and rising rates are a tailwind for major banks. There are a lot of moving pieces on both sides. When there's so much short-term noise, I find comfort and confidence in staying attuned to the long term. I have no doubt that the next year or two is going to be tough for the global economy, which undoubtedly impacts the likes of JP Morgan Chase. Over the long run, however, this is one of the biggest and best financial institutions on the planet. They'll get their fair share of US and global growth because of it. Even if near-term earnings per share growth is only in that low single-digit range, they still have the flexibility on dividend raises. By virtue of the low payout ratio, there's room for high single-digit dividend raises even in this environment, and the coming years could see further dividend growth acceleration from that level. With a 2.9% starting yield, I don't see anything to dislike about that. Moving over to the balance sheet, the scope and complexity of their numbers can make it difficult to decipher what's going on, but I see nothing to indicate anything less than a rock-solid financial position. The bank has $3.7 trillion in total assets against $3.4 trillion in total liabilities. JP Morgan Chase retains the following credit ratings for its senior unsecured debt: A2 Moody's, A- Standard & Poor's, AA- Fitch. These ratings are well into investment-grade territory. Profitability is strong with steady improvement over the last decade. Over the last 5 years, the firm has averaged annual net margin of 27.6% and annual return on equity of 13.1%. Net interest margin came in at 1.6% last fiscal year. JP Morgan Chase is an absolute powerhouse that's set to prosper alongside the United States of America. And with enormous economies of scale, high switching costs, unique financial expertise, and built-up relationships, the company has durable competitive advantages to protect itself. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. I see all 3 of these risks as elevated for big banks in general. Banks are directly exposed to economic cycles. A recession, which could be caused by any number of factors, would have a severe and negative impact on the company. While their absolute size is an advantage, it also limits the relative growth they can produce. And ongoing technological changes in banking could make it easier for smaller players to take market share from bigger players. Even with these risks out in the open, the bank still strikes me as a great long-term investment candidate for dividend growth investors. The attractive valuation only serves to make me more enthusiastic about it. The stock's price-earnings ratio is sitting at 9.1. That's less than half that of the market's earnings multiple. It's also well below its own 5-year average of 13.1. The price-to-book ratio of 1.6 is right in line with its own 5-year average, and the yield, as noted earlier, is substantially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. The 7% number looks awfully conservative when you compare it to the bank's long-term demonstrated dividend and EPS growth. There's also the low payout ratio, and we're in an environment where interest rates are rising. All of that bodes well. However, I also have to account for so much uncertainty, and the near-term earnings per share growth forecast is somewhat meager. Overall, I do think the bank can pull multiple levers and meet or exceed this kind of dividend growth over both the near term and the long term. The dividend discount model analysis gives me a fair value of $142.67. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates JP Morgan as a 3-star stock with a fair value estimate of $152. CFRA rates JP Morgan as a 3-star hold with a 12-month target price of $175. I came in low this time around. Averaging the three numbers out gives us a final valuation of $156.56, which would indicate the stock is possibly 12% undervalued. Here's the bottom line, guys. JP Morgan Chase & Co. is a financial powerhouse that's intertwined with and critical to the United States of America. As the U.S. prospers over the long run, so should the bank. With a market-beating yield, double-digit dividend growth, a low payout ratio, more than 10 consecutive years of dividend raises, and the potential that shares are 12% undervalued, this looks like a great portfolio candidate for long-term dividend growth investors. And now for a special news announcement. Air Products and Chemicals Inc., stock ticker APD, just got upgraded to overweight with a new target price of $275 from JP Morgan Chase. With the stock currently priced at $235, that's a lot of potential upside. We put out a full analysis and valuation video on Air Products and Chemicals about a month ago highlighting its appeal. If you haven't already taken a look at this name, this upgrade might be a sign to change that.
Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.